Tenaga Nasional intends to invest upwards of 90 billion over the next 6 years for its grid infrastructure, of which 40% will be channeled towards energy transition-related capital expenditure, says TNB President and Group CEO Datuk Baharin Din. In his closing remarks for the Energy Transition Conference 2023, Baharin said that it is a key priority of the national utility to strengthen our ASEAN interconnection to facilitate its net zero emissions goal. He says that parties are committed to making it happen, as the interconnection will enable better RE ambition, support system security, and open up the gateway to over $6.3 trillion of new investments by 2050. He adds that the timing is right to make the ASEAN power grid a reality, as it is now a matter of our survival. TNB, which operates 62.25 billion worth of regulated transmission and distribution assets in the country as at end 2022, has been closely watched amid rising interest towards renewable energy capacity installation and the national plan to allow RE exports to neighbouring countries. Studies were also made in the past for transmission links between East and West Malaysia, as well as between West Malaysia and Indonesia, according to the International Energy Agency. Development of a flexible cross-border grid is one of TNB's 3 objectives in its 2050 energy transmission pathway, aside from decarbonisation of its power generation segment and the empowerment of its prosumers and cross-sector electrification. Public Bank's second quarter net profit improved by 14% year-on-year to 1.62 billion as a result of continued healthy loan and deposit growth, prudent cost management, as well as stable asset quality. Revenue for the quarter grew by 26% year-on-year from 4.97 billion to 6.26 billion ringgit. Public Bank also declared a dividend of 9 cents per share. For the first half, net profit rose by 18% year-on-year to 3.33 billion from 2.82 billion previously, while revenue improved by 26% to come in at 12.39 billion ringgit. Managing Director and CEO Tan Sri Dr. Teh Alex said net interest income increased by 3.4%, mainly led by the loan and deposit businesses. He said non-interest income grew by 5.4% on the back of higher income from forex and stockbroking businesses. Teh said with the continued expansion of the Malaysian economy, business prospects for the banking sector remain positive. He added that there are also growing opportunities arising from the increasing demand for digital banking and ESG products. Teh also addressed Public Bank's move to continuously combat scams through the implementation of stronger authentication methods, as well as the introduction of a cooling-off period for banking transactions which are deemed to be abnormal. IHH Healthcare has appointed Dr. Prem Kumar Nair as its Group Chief Executive Officer effective October 1st. Prem is currently the CEO of IHH Singapore, and he will continue to hold that position until September 30th. At the same time, the hospital operator announced that its Group COO, Jo Sim Heng Joo, has decided to return to public service and tendered his resignation. This appointment puts an end to IHH's search for a new captain that began in February this year after its previous CEO, Dr. Kelvin Loh Chi Kyun, resigned on February 22nd. Sim had assumed Loh's duties during the search. Meanwhile, IHH saw its second quarter net profit halve from 612.1 million to 301.8 million due to the previous year's high base as a result of exceptional items exacerbated by forex losses following the devaluation of the Turkish lira. In contrast, revenue for the quarter improved by 7% year-on-year to 4.7 billion, driven by more patients. It was a different story for the first half, where earnings grew by 53% year-on-year to 1.7 billion as revenue increased by 15% year-on-year from 8.5 billion to 9.8 billion ringgit. Going forward, IHH says that it will continue its organic growth path by expanding its bed capacity by around 25%, driving productivity and operational efficiencies, while reconfiguring its portfolio to improve its returns with a focus on removing underperforming assets. RHB Bank expects the interest margin squeeze the spread banks earn between borrowing and lending to ease in the second half, driven by lower competition in the deposit space. According to MD and CEO Mohammad Rashid Mohamad, the bank is looking to improve NIM to 1.8 to 1.9% for the full year, despite the increase in funding costs and expectation that NIM would continue to tighten in the near term. NIM compression in the first quarter was steeper than expected due to a pickup in the deposit war between banks. NIM for the quarter contracted to 1.82% from 1.9% in the preceding quarter, taking first half NIM to 1.85%. Mohammad Rashid elaborated that RHB would defend its retail and current account savings account deposits and continue to maintain cost discipline and investing strategically in digital efficiency to manage persistent cost escalation. He said that given the expected economic expansion of 4.3% in the second half, RHB expects loan growth to be at 4% for the full year against an earlier projection of 4 to 5%. For its second quarter, RHB posted a 28% year-on-year increase in earnings to 808.7 million, driven by higher allowances for credit losses written back, partly offset by lower net funding income and higher operating expenses. Revenue jumped by 37% to 4.05 billion for the quarter. RHB declared an interim dividend of 15 cents per share. For the first half, net profit increased by 30% to 1.57 billion from 1.21 billion previously, as top line jumped by 38% to 7.97 billion ringgit. Axiata Group's net loss widened to 576.2 million for the second quarter from 106.4 million a year ago. Revenue for the quarter rose 15.3% year-on-year to 5.99 billion ringgit. The group attributed the wider loss to the lower share of results from Celcom Axiata, which is no longer a wholly owned subsidiary following its merger with Digi.com. Its Nepal-based telco Ncell also saw a non-cash impairment of assets and capital gains tax write-off following the unfavourable outcome from the bilateral investment treaty arbitration proceedings in June. However, this was offset by a 402 million ringgit gain from the final closing adjustments to the Celcom-Digi merger. For the first half, Axiata's net loss deepened to 502.4 million versus 149.5 million a year earlier, as revenue increased by 12% year-on-year to 11.4 billion from 10.2 billion ringgit previously. Despite the loss-making quarter, Axiata declared an interim dividend of 5 cents per share. Chairman Tan Sri Syaril Ridzaridwan says the group is poised to extend its market leadership beyond the double-digit top-line growth seen in the first half of FY 2023. Group CEO Vivek Sood says cash generation, improved balance sheet and capital expenditure to chase growth opportunities has been the focus of the first half, and that it will remain so for Axiata for the rest of the year. Meanwhile, Vivek said that Axiata will be easing back on the pace of its capex as it wants to be more careful in investing in its frontier markets, particularly those with less favourable macroeconomic situations. He says the focus is now on monetizing its current assets and bringing down its debt levels. Axiata has revised its capex guidance lower to 6.5 to 6.8 billion for FY 2023 from the 7.1 billion guided earlier this year.